In March 2022, two brothers, Jake and Mike, checked their investment accounts. Over the exact same 3-year period, they had both put away exactly $28,800. Jake followed standard advice, pouring his money into index funds, but he was down $4,700. Mike bought boring, outdated assets their grandfather recommended. While the market collapsed, Mike's account surged. He was up $22,000. Jake was playing with half a playbook. Buying and holding index funds works wonderfully during 40-year bull markets, but that strategy shatters the moment the economy goes into a freefall. The standard portfolio Wall Street sells the public leaves average investors entirely exposed when times get chaotic. It relies on a constantly expanding economy to survive. This exact split in outcomes happens every time the markets break. We can trace this exact pattern back 100 years, right through the panic of 1929. Most people think a market crash vaporizes money. It doesn't. We are looking at the crisis transfer theory. Institutional wealth actively migrates, abandoning collapsing equities to seek immediate safety. The billions of dollars managed by pension funds and family offices always flee to assets with 3 specific traits: tangible physical scarcity, essential human utility, and a history of surviving panics. You don't get through an economic catastrophe by holding your breath and hoping your account recovers. You do it by moving your capital to the exact locations where the institutional money is quietly flowing. The first destination for this capital is gold mining stocks. Note that we are not talking about buying physical gold bars, but rather the actual companies that dig the metal out of the ground. When government currencies lose credibility, investors flock to gold, driving its price up. But the cost for these companies to extract the gold stays relatively flat. That fixed cost, stacked against a rising sale price, creates an explosion in their profit margins. During the worst years of the Great Depression, while banks failed and the broader market cratered, America's largest gold producer, Homestake Mining, saw its stock rise 474%. The second major destination is long-term United States Treasury bonds. These serve as the ultimate safe haven for massive institutions. This mechanism is known as a flight to quality. When credit freezes in a deflationary crash, insurance companies and foreign governments are forced to park billions somewhere secure. They buy up government debt. That massive demand drives the price of those bonds up and their yields down. This diagram illustrates how a mechanical counterweight operates. As the heavy momentum of a stock market crash pushes the left side down, the exact same downward force launches the crisis assets on the right side straight up. The third asset class is farmland. While retail investors ignore it, some of the wealthiest people on Earth, including Bill Gates, who now holds over 270,000 acres, are quietly buying up agricultural acreage. Farmland represents absolute physical scarcity. The amount of productive land actually shrinks every year due to urbanization, yet it continuously generates steady cash flow through crop yields to feed a growing population. The fourth asset is consumer staple stocks. These are the boring, everyday companies that manufacture basic household necessities like soap, toothpaste, and coffee. They rely on inelastic demand, meaning people buy these products regardless of their personal financial situation. Consumers will prioritize cleaning products and groceries, whether the economy is booming or stuck in a deep depression. This chart shows the recovery timeline of 2 different portfolios. Consumer staples might not double overnight, but because their value refuses to crash like the deep plunging line, they allow your money to start compounding and recovering years ahead of a standard index fund. Protecting your wealth does not require predicting the exact day the market falls apart. Instead, it requires deliberately pre-positioning 10 to 20% of your portfolio into these safe categories, well before the panic begins. This animation shows the first macroeconomic warning sign, the yield curve. When short-term interest rates drop back below long-term rates after a long period of inversion, the curve normalizes. The moment those lines cross back, the clock starts ticking toward a recession. The second signal is widening credit spreads. That is the gap between what corporations pay to borrow money and what the government pays. When that gap rapidly expands, it tells you institutional investors are terrified about corporate defaults. The final confirmation is the unemployment rate ticking up from cycle lows. By the time that metric starts climbing and the Federal Reserve notices, it means they are already too late. The economic contraction is actively happening. Moving your capital when you see these signals is exactly like buying fire insurance. You acquire it while things are calm, because the cost of waiting until the flames are visible is catastrophic. Remember Jake staring at his negative balance. The financial industry hides this secondary playbook from retail investors, because Wall Street cannot charge you perpetual management fees if you rotate your wealth into self-sustaining crisis assets. The market operates as two separate systems. There's the game of growth, and there's the game of crisis. To keep what you earn over a lifetime, you must learn to play both simultaneously. An unprotected portfolio relies entirely on the hope that the good times never end. Generational wealth relies on calculated positioning for when they do.